In a way, though, are the hyperscalers, the big tech companies, more protected themselves from that potential downside versus some of the folks who are taking the overage from them? Maybe the core weaves, maybe the equipment makers who they're buying from now but might slow down their spending on later. I mean, these are big companies with outside businesses, not just based on what they're doing specifically with AI right now. They could stay warm during winter, right?
Yeah, well, certainly these businesses, Google, Amazon, Meta, they all have core businesses, which, to be frank, are the way in which they're financing all of this AI spend. The challenge is basically what's happened is they've channeled all of their free cash flow, something like 60, 70% of the free cash flow right now, and moving towards basically all of their free cash flow into a huge AI bet. And what that highlights is that there's a real risk that they don't get the return on investment from the spending that they're doing. And so that's really the question, not, Google, Amazon, Meta, et cetera. These companies are going to be around for a long time. The question is, would they be better off, distributing that capital to shareholders or investing in all this infrastructure that may or may not be useful? And then on top of it, are investors themselves into those stocks really pricing in the right probabilities that they'll get a payoff? Look, the free cash flow yields on these companies are very low at this point.
Well, that is the question then. Well, we're talking about an AI data center version of the warehouse build out that Amazon did during COVID that they then had to digest and recover from. Won't the whole market potentially suffer if that ends up being the case with AI? And as an investor, how do you strategize around that?
Well, I think as an investor, you basically have to use this opportunity, this mania, to take some profits here. There's no reason to go all in on this trade, given the overall picture is not looking particularly compelling from an ROI perspective across the whole sector. So, use these rallies to take some money off the table, create a little more diversification in your equity portfolio, and
that's what you said about gold a couple of weeks ago, Bob, and that was a very prescient call based on what gold has done since it was at 4,300 or so.
Yeah, that's right. I mean, look, one of the things you learn if you've been in this business long enough is don't be greedy. And in the world of the financial markets and in a world of sort of speculative manias popping up everywhere, if you're a long-term investor, you're going to win because you probably have some bets on the table in those various areas. But the way you're going to win is by not leveraging into the mania, but by taking your luck and taking your chips off the table when you're deeply in the money.